Hi, everyone. Welcome to the Capital Raiser Show, Season 5, powered by the Family Office Club. I'm your new host, Weston Walker, and we interview only the best investment managers and entrepreneurs. Shout out to our sponsors, Capitalist Pro, the Family Office Club, and Invest Next. Today we have John Park, founder of PGI Self-Directed. A little bit different episode today. John has 20 years experience setting up retirement accounts, self-directed, helping people invest out of their retirement account into products like real estate, businesses, etc. So, John, welcome to the show.
Thank you very much.
Yeah, so tell us a bit about your background and then why self-directed accounts in the first place.
Wow, how far do you want me to go back? As you can tell, I'm not as young as you are. So, let me give you a brief history. So, in my first life, and I think I'd mentioned this to you before, Weston, is I was actually in college athletics in administration. So, I worked for a number of years for the Big Ten Conference office in the Chicago area, and then I was recruited for an assistant athletic director's job at Arizona State University. And I went there. I left there around 2000. My wife is the volleyball coach, so yes, it was an office romance, so to speak. And first two kids, she kept coaching. Third kid came along, and she was like, "I can't be 100% mom and 100% coach." And that's how she's wired. And so she retired from coaching. She wasn't fired or anything, but she's in real estate now. But when it came time for the third child, she wanted to kind of be home and actually raise the child day to day versus having grandma, take care of the kids and stuff. So I've been in the self-directed world for about 20 years. Started around 2006. PGI self-directed only sets up self-directed retirement accounts, which I know we're going to be talking about today. So, I think you know this, Weston, but for the people who are listening, we're not the financial planners. We don't invest people's money. We're just setting up the structure, and it's what's called a checkbook control structure. And we can kind of talk about the pros and cons of checkbook control versus not controlling a checkbook. But yes, I've been doing that for about 20 years, but that is the business, is setting up the three structures that I think we're going to be talking about today.
Sounds good. Yeah, and tell us about why self-directed accounts. Why should people even go into the process of paying money, setting up the self-directed account, taking, however many weeks to set it up?
Okay, I'm gonna throw out something here. I'm gonna say, well, not everybody should self-direct, and that's very true. There are people who are not, disciplined with money, maybe shouldn't be doing self-direction, but the benefits can be quite substantial because most people don't understand that their IRAs and 401ks can actually invest into a multitude of investments. And it's not that the companies, like the Schwab and the Fidelities are providing a disservice, but they're specifically set up to do a few things, and that's to sell stocks, bonds, and mutual funds, and certainly variations from those types of assets. They don't make money when somebody invests what we call non-traditionally. Non-traditionally could be a plethora of investments, real estate. It can still include stocks, bonds, and mutual funds, but specifically things like, real estate, hard money loans, real estate syndications, commercial real estate, cryptocurrency. I mean, the list literally goes on and on. And kind of the nice thing with this, none of us really like the IRS, but they actually make understanding assets, what assets you can invest into, pretty easy. The only thing that an IRA cannot invest into are life insurance contracts and collectibles. That's it. Now, there's other rules that we'll kind of touch on, but that's the only thing as far as assets go that an IRA cannot invest into. Technically speaking, when we set up a 401k plan, it can only not invest into collectibles. Now, I always tell my clients when I visit with them, it can't do life insurance contracts and collectibles just like an IRA, just because most clients are not going to be investing into life insurance contracts. Technically speaking, a 401k the adoption agreement can be written to allow life insurance contracts. It's just that most people don't have an interest in doing that. But kind of getting back to the benefit, it allows people to do things that maybe they want to invest into. Because what I hear a lot is somebody will say, well, my money's tied up at Fidelity into an IRA or a 401k or something like that, but I don't even know anything about those. But I know real estate. I know lending money. And sometimes people are just interested in doing something different, even if they don't maybe have an expertise. They want to grow and have an expertise to do things outside of the market. So that's the obvious benefit. I think you said something about the timing, right?
Yep.
So timing can generally go. I'm conservative by nature, so I just tell people generally expect 2 to 3 weeks. So when I'm first visiting with a prospective client, one of the first things I'm going to ask them is, do you have an investment that you've already identified? Yes or no? And then if you've identified an investment that you're wanting to do, what's the deadline? Because sometimes people in this industry or outside of this industry think, well, I'll just get it set up. I'll have the monies wired in. And so, what, 2 days? That's not usually going to be the case. On the 401k side, we can usually get everything done within 2 weeks because I control that part of it. I'm preparing the documents for their 401k plan. So it's just a matter of me getting in, grinding them out, getting them out to the client, figuring out where they want to open the account for the 401k that's actually going to hold the funds. Most people in the self-directed world will actually open the account at a local bank or at one of the banks that we work with, and we're not compensated by any of those banks. It's just options for people. But on the IRA side, there's some other things that come into play. And this is good education for your listeners. An IRA under the law has to be held, if you want to put that in air quotes, has to be held through an IRS approved custodian. So even if I'm setting up something for you right now, Weston, and we're going the IRA route, bottom line is it's going to take us 3 days minimum just to get the IRA account open with the custodian. Well, we've almost used about a week. And if there's any delay in that process, it's going to be like 4 or 5 days just to get the account open. Once we get the account open, then we have to have the account before we can request a rollover or transfer of other funds. So a lot of my clients will obviously be rolling over funds from maybe a previous employer's 401k plan or an IRA that they currently have at one of the big boys. And so a lot of times people think, oh, well, once we have the account number, we can just send a transfer form or I can make a rollover request and the money will be sent the next day. Typically, that's not going to be the way it works in this industry. If the funds are moved within 4 to 5 business days, that's actually considered pretty fast. Now we're at 2 weeks. And then you factor in a third week potentially, even though it shouldn't take that long. We factor in a third week just because life happens. Sometimes people just don't respond to things quickly and do things efficiently. But there are companies in this space, and I don't talk about, refer to companies' names, et cetera, but there are some companies in this space that they're not lying about something, but they'll say, oh, get your self-directed plan, set up in 2 days. It's we can get something started. We can actually get a lot of things accomplished in 2 days, but to have the account opened and funded in 2 days is just not going to happen because, again, the movement of monies is what's going to take the time.
For sure. Yes, you have three different types of accounts that you set up that are self-directed. You have the IRA LLC, the IRA Trust, and then the Solo K. So talk a little bit about those and then why investors should choose a specific one according to their needs.
Great question and right on point. So the IRA LLC is kind of the standard bearer on the IRA side of the family because for decades, this kind of a structure has been approved. It's gone to tax court with the IRS. As long as everything's structured correctly and as long as the investor doesn't, perform prohibited transactions, because there are rules that have to be followed, which we'll touch on. But bottom line is, in this case, the IRA LLC is a structure where we form an LLC. It doesn't have to be in the person's state of residency, but typically that's what most of my clients would be doing. And that the key thing to remember with the IRA LLC is the LLC is owned 100% by the IRA. A person will never combine personal funds. They won't take money out of that account to go to the movies. It is strictly an account that is not only owned 100% by the IRA, but all the money within that plan can only be used for permissible investments made by the IRA. That structure provides the person checkbook control. So with the IRA LLC, somebody might ask, well, do I have to have checkbook control in order to self-direct? No. And everybody I talk to, that's one of the first things I'll tell them. You don't have to have a checkbook control structure in order to self-direct. You could move your monies directly to a custodial account where they hold the money, they process the investment paperwork, they do all of that stuff. However, a lot of people do not like that structure, especially when they know they can control the checkbook for two main reasons. One is when you use the custodian structure where there is no checkbook control. It's just what I call custodian frustration and fatigue. Meaning is that custodians, they're maybe really good at being custodians. Sometimes they're not the best at processing investment paperwork. So invariably, people get very frustrated because they'll want to do an investment and they may want to do it in 3 days. Like I deal with a lot of people that do hard money lending, and they're making decisions like within 2, 3 days. And then they reach out to the custodian and they go, "Hey, I need money to loan to Weston. We need to get this going. How long is it going to take?" And the custodian says, "Oh, 2 weeks." Okay, that doesn't work very well. So that's issue number one. Issue number two is just fees. So a lot of times people think by setting up what they think is something special with the checkbook control, that they're actually going to be spending a lot more money in fees for that ability to control the funds. Actually, it's probably the opposite of that. I will honestly tell somebody in the first year that I set up their IRA LLC structure, it might be or might not be higher or lower in fees compared to if they just go to a custodian. But what I can promise them is the longer and starting really in the second year and for sure by the third year, their fees will actually be less. And here's where we get into the honest truth about custodians that don't allow checkbook control, is they're going to charge you for everything. So, and that's fine. That's their business model and they have every right to do that. But custodians in that space, they charge you for every transaction they do, every asset that your IRA purchases. So if you go out and purchase, let's say 5 assets, well, you're probably going to be spending $800 or more just to have those 5 assets being held within your IRA and the custodian doing the work associated with that. A lot of the custodians, they have the transaction fees, they have the asset fees. Some, which I think is really criminal, they have balance fees, which I've never quite understood, because if Weston started his account with $100,000 and grew it to $1 million, why should he pay more money just because his balance has grown? So those are the things you totally escape when you control the checkbook. Now, for someone like we were talking earlier who's maybe not disciplined, maybe controlling the checkbook is not a good thing. I mean, that's a decision that the investor has to make. But that is the kind of the benefits with the IRA LLC is you control it through that LLC where the IRA is the 100% member of the LLC. And then in this case, Weston, if it was you, you'd be the manager. So you can control the investments. You make those decisions. You do the wires, the checks, etc. But the technical legal owner of that LLC is your IRA. Now, let's go to the IRA trust. Somebody might say, well, if the IRA LLC is kind of the one that's been around forever, it's the standard bearer in the industry for IRAs with self-direction, what's this trust? Why do you have it? Because why wouldn't you just stick with the IRA LLC? Well, there are 50 states in this country, and there are some states that have very high fees associated with forming an LLC. Let's pick on our neighbors to the west, meaning in California. So California only charges $70 to form an LLC, which is nothing in cost-wise compared to most states. However, once you form the LLC, the lovely organization called the California Franchise Tax Board now is going to be charging you $800 a year just for the benefit of having that LLC, even if the LLC is not an active business. Because in this case, the LLC that we'd be setting up is just making passive investments on behalf of its owner, the IRA, which generally speaking is going to be making passive investments, which will be either tax deferred or tax free if it's a Roth IRA. So I was speaking with an attorney a number of years ago, and we got introduced to each other. And I said, his name was Frank, and I said, "Hey, Frank, I have a lot of clients in California. I also have clients in Massachusetts, which is another really expensive state. And there's about a handful of 6 or 7 states that are really kind of cost prohibitive." And I said, could we form an IRA trust where the trust now, different terminology, the IRA is the grantor as compared to the member with the LLC. Weston, instead of being the manager, he's the trustee. But the flow of the investment process and the return of investment returns works exactly the same. We're just using a revocable grantor trust versus an LLC. Now, what does that mean for Weston? Well, if he lives in California, he can form the trust. He doesn't have to form a California LLC. He doesn't have to worry about getting charged $800 a year, but he can still control the investment cycle just like an LLC. It's just a different structure. So if I'm talking to somebody and they call me and they're from California, I'm going to explain both to them. But if they say, hey, I want to do the IRA LLC, I have a client right now, she just doesn't want to mess with it. She just says, let's just do the LLC. And I said, okay, you're going to get charged $800 a year. And she goes, yep, I get that. But it gives the person the option to do the IRA trust and then avoid those LLC expenses and reporting, because every state, not every state, but most states have a reporting feature with the LLC that you have to do something every year. So that's really the main reason of having the trust. Now, when I visit with people, I send out a blog post that the attorney and I did, kind of explaining the comparing and contrasting the LLC versus the trust. There's pros and cons to each. So that one's just an individually decided transaction as far as do they want to do the LLC or they want to do the trust. But the one thing I want you to know and your listeners to know is whether they did the IRA LLC or the IRA trust, they're still going to control the checkbook. The flow of the money is going to be exactly the same. It's just using a different vehicle to get to the end result so they don't have to have those costs associated with it. And then finally, we have the solo K. So the solo K is a wonderful structure and it's just a great thing to have, but you have to qualify for it. So qualification is not really as difficult as some people think. It is intended for an individual who is self-employed, who's operating a business on an ongoing basis with the intention of generating profit, and they have no employees. The exception to that is their spouse. If it's a spouse-owned business, both spouses, as long as they're materially participating with the business, they can both not only roll monies into the 401k plan for investment purposes, they can also make contributions to the 401k plan based on their self-employment earnings. Now, every so often I'll get somebody who will call in and they'll have read something about some of the benefits of the 401k and they go, I want the 401k. And I go, well, whoop-de-doo, that's great. Do you qualify for it? So it's like I said, it's not difficult, but there has to be legitimate self-employment activities on either a full or part-time basis. So you could have a W-2 person who could still have their own individual 401k plan. They might be, I have a client who they're doing DoorDash. And now they're responsible to make sure that while they're operating the 401k plan, they're actually operating that business. But I use that as an example to show you how easy it might be to qualify for the 401k. But yes, you do have to have that self-employment with no employees.
Awesome. Yeah, so go into a little bit more of the rules around, the self-directed process. Are there any things investors should be aware of or, be aware of when setting up these accounts?
Yeah, absolutely. So when I visit with people, I really kind of go into a deep dive with this. But let's go just cover the basics for right now. And then if you want to dig deeper, Weston, this is your show, not mine. So the first thing is disqualified assets, and we kind of referred to that earlier. The only assets that you can't invest into are life insurance contracts and collectibles. So the corny humor I use with people when I talk to them, if Weston called me every day for 4 straight days, and one day he's saying, hey, can I do a rental property? Sure. Can I do cryptocurrency? Sure. Can I do a real estate syndication? Sure. Can I do hard money loans? Sure. Weston calls me the 5th day. Now, Weston, I would never be this rude to you, but I'd say, hey, Weston, you've called me now 5 straight days, and you're basically asking me the same questions, just different assets. And you go, yeah, I just want to make sure I'm not breaking the rules. And I'm going to say, as far as an asset goes, if it's not life insurance, if it's not a collectible, you can put a check in that box, move on to the next issue. The next issue, I'm going to kind of do more from a 50,000 foot view level, is what's called disqualified individuals. And these will be people who the IRS says, and I'll explain what it means, but the IRS says you have to have an arm's length transaction position from your retirement plan. In effect, what they're saying is any person who's considered a disqualified person cannot be materially benefiting, and I'll explain that, materially benefiting from the investments that their plans do, nor can any of those disqualified individuals provide a benefit to the retirement plan. So who are these people? So I always use the example of a cross or a horizontal and vertical plane crossing each other. So Weston, I'm going to pretend for a second. You're married, you got kids, you and your spouse both have parents, grandparents who are all still alive. They're on that vertical plane. So at the intersecting points of the planes, you and your spouse are what's considered disqualified people. Even if it's your retirement account, your spouse is considered disqualified to your account as well through marriage. Children below you are disqualified people. Parents, grandparents above you and your spouse are considered disqualified people. What does it actually mean? In simple terms, like I said, you cannot be materially benefiting. This is where some people might go, well, wait, John, that doesn't even make sense. Because if I'm really good with my investing in my IRA or my 401k, of course I'm benefiting. And of course, everybody knows that. What the IRS is basically saying is you cannot be personally benefiting from that transaction. Easy example, Weston's a realtor, let's say. He goes out and uses his funds to buy a rental property, and he gets a commission for doing that. Receipt of that commission would be a problem because now you personally benefited from an investment that your plan made. Let's use an example I always use with kids. Let's say you're going to the university, your kid's going to the University of Illinois in Champaign-Urbana in Illinois. And prices are good there, relatively speaking. You visit with your spouse and you go, hey, let's buy a rental property, a little townhouse condo. Our kid can live there. They're going to have some roommates. We're buying property, historically proven to be usually a good investment for people. You say, hey, John, my kid's going to pay their fair share of rent. Still a problem because they're a disqualified person to the plan. They cannot receive a benefit associated with that asset that is owned by the retirement plan. So those are examples of receiving a benefit. People usually go, well, how would any of these people provide my retirement plan a benefit? Let's just use a really easy one and we'll keep it to real estate. Let's say your plan had a rental property and you have tenants in there. None of them are disqualified people, of course. And you get a call from your tenant one day and they go, hey, Weston, toilet's broken. Dude, this needs to be fixed. And you're a handy person. And so you go, explain to me what's going on. They explain it. And you go, I think I can go get a part at Home Depot for like $5. I'll be over in 30 minutes. Probably take me no more than 5 minutes to complete it. Well, you could almost have two prohibited transactions because number one, when you go to Home Depot, that part would have to be paid for by the retirement account. That's number one. Number two, if you went over there and fixed it as a disqualified person to the plan, you're providing a benefit to your IRA or your 401k that it would naturally have anyway because doesn't have hands, it can't fix toilets, but somebody has to fix it and you're a disqualified person, so you go over there and you fix it, takes you 5 minutes, you technically violated the rule. So then Weston may say, oh, so as long as my retirement plan pays me to go do that, then that's okay? Nope, because now you're receiving a tangible benefit because you got cash from the retirement account that you paid to yourself. That would be a big, big no-no. So those are kind of the basics and the kind of very brief explanation of disqualified people. Now, remember I said there's a vertical plane and there's a horizontal plane. So people on the horizontal plane include cousins, nephews, nieces, brothers, sisters, aunts, uncles, strangers, friends, business associates. Those are all people by definition that are not disqualified to the plan. So if Weston said, oh, so wait, you're telling me I could maybe do an investment with my brother? And I go, yeah, that shouldn't be a problem. And you go, but does my brother have to set up a self-directed account? No, not necessarily. I mean, they could, but they're not required to. But those would be the people then that you could do investments with, like a co-investment on something. And generally speaking, I mean, some people are kind of ingenious on how they want to do things that are against the rules. But generally speaking, yes, that wouldn't be a problem. And those are people that are not considered disqualified. Third thing, just called self-dealing, kind of talked about it, just means that neither the plan nor the disqualified people can benefit from doing transactions with each other.
Awesome. Yeah, so go into a little bit about the taxes with these retirement accounts. I know this is highly personalized for each person. Just talk briefly about the taxes.
Yeah, so it's very fair when I'm talking to somebody, when I bring up taxes, it's very common that somebody could say, why is there taxes? I have my IRA account at Charles Schwab right now, traditional pre-tax IRA. I'm not getting taxed on anything. Or better yet, they have a Roth and they go, I'll never be taxed. And generally speaking, that would be true. However, the taxes associated potentially with an IRA or a 401k has nothing to do, because I get this quite often. Somebody will say, so the IRS is just attaching taxes potentially to an investment, because they don't want people to self-direct, right? No, that's not the case at all. The visual that I would be giving any of your investors that I talk to would be is if you make an investment that goes outside the box of what's considered passive. Passive includes things like interest income, rental income, dividends. Those are all things that are absolutely passive. However, there are two ways that it's not illegal for an IRA or a 401k to be taxed. And the first one is a tax code that's called UBIT. And I'm going to do this at a really high level because it can get complicated pretty easily. So think of UBIT as if your IRA or your 401k receives investment returns based on an active business. So we're not talking passive. And the quick example I'll give is, let's say John has a restaurant and John reaches out to Weston and says, "Hey, Weston, I want you to invest some money into my restaurant. I need some money." And you go, "Well, what am I going to get out of it?" Now, if I said you're getting 13% interest on your money, that's passive. Interest income is passive. But I go to Weston and I say, "Hey, Weston, how about instead of giving you 13% on your money, for a certain period of time, I will give you a percentage of my profits from my business, the restaurant." That would not be illegal. But now the IRS says, "Hey, your IRA is now actually getting money from an actively run business." And by the way, there's a very good reason that I won't bore you and your listeners with right now. There's a really, really good reason why this tax code exists, by the way. But it's not illegal. But now once Weston makes, loans that money and he gets that return, the IRS no longer considers that a passive return. They consider it an active return. So some of the money that you would be getting from me in interest from my restaurant, there would be a calculation. Some of that would be taxable, even if it was a Roth. That's a very, very, very quick description of UBIT. The next one is what's called UDFI, and it stands for Unrelated Debt Financed Income. Again, I'm going to keep this really brief for now, but I'll give a visual. So again, the IRAs are supposed to invest passively. So let's say you want to go out and buy a rental property for $200,000 and you had 175, excuse me, you had 175,000 in your IRA account, but you loved this property and you're like, "Dang, I'm short 25,000. But then you call me up and you go, "John, I think I heard you say something or read something online that my IRA LLC could actually hold debt, could hold a mortgage in effect." So you go out and I say, "Yes, there's rules that have to be followed," and I won't, bore everybody with that right now. But let's just say you followed all the rules and you go to a bank or a private individual and you get that loan, not you personally, but your IRA LLC gets that loan for 25,000. That's debt. So now I'm going to use an easy example. You turn around, hypothetically, and you sell it 6 months later, and you make significantly more than what you purchased it for. But you had debt. So now some of that return that you got back from selling the property came from money that was generated by debt financing. So again, it's not illegal, but in that example, your IRA would owe some taxes because it incurred debt in making the investment. Most of my clients aren't going to be doing investments that will trigger those taxes, but it's always really good that people know that that exists, because if I don't tell them, or companies like PGI doesn't tell folks that, naturally they would just make an investment and go, "Oh, well, there's no taxes on this," when there actually could be a tax.
For sure. Yeah, a lot of helpful information there, John. I've talked to people that don't know the self-directed space exists. They think they can only invest in stocks, bonds, mutual funds inside of their IRA, but they don't know this space exists. So thank you for coming on the show, John. How can investors reach out to you if they want to set up something like this?
Well, first of all, if they're one of your investors, I can, because of our relationship, they can get a little bit better fee structure from that standpoint. So you could have them reach out to me directly. If they do, have them let me know that they're attached to you, so they can get that kind of a benefit. If you want them to, reach out to you first and then you introduce to PGI, it's totally fine. It's whatever you want to do. It's whatever your investors want to do. And just for the listening audience, who will be listening, this, Weston, you're not paid anything by PGI. So there's no selfish interest on your part from personal compensation. And obviously, there's a lot of companies out there that do this. So it's just a matter of, who do they want to work with? Who do they trust? Who do they like in setting up the structure for them, whether it's the IRA or the 401k. But yeah, just however you want to get them introduced to PGI is however you want to do it.
Sounds good. And yeah, whoever's listening that's not in my personal network, my email is weston@westrockequity.com. That's weston@westrockequity.com.